the Spy Surfer. And I'm gonna go, there you go. I'll start by giving you a short introduction about my background. So as you can tell from my first name, I am from France, where I was born and raised. Then I crossed the channel. I went to England, where I took my master engineering. It was in satellite communication. I learned how to launch satellites in space. It was fun, never used that so far. I worked for a great company, Canadian company called Nortel. It was a great company, and it's not my fault what happened afterwards. But and that took me from France to Asia, to Hong Kong, where I lived for almost 5 years, and I really enjoy that place and the whole Asia. After that, I went. I married a lovely Canadian lady. She told me everything about Vancouver, so I was sold. Came here, knew no one, so I thought, okay, I'm going to go back to school. Took my MBA at UBC, awesome place, not only to study. And then afterwards, I worked in the construction, where it's very dirty. You have concrete and stuff. It was fun. And then after almost, 15 years in the corporate environment, I decided to unplug the whole thing and take a break. Think about, okay, what do I really want to do? You know, you call that life crisis, or whatever. But that's what I did. We had 2 kids, and it was a bit crazy, but anyhow. And I started the Spy Surfer, which essentially is a provider of quantitative models. So in plain English, that means that I'm using models to invest my own money. This is what I do full time, and that became a real passion. I'm totally fascinated by this finance industry, and I'm going to take you through why the Spy Surfer. We'll talk about afterwards more about quant stuff. Why I'm using quantitative approach as opposed to discretionary, all right? So why the Spy Surfer? In order to answer this question, we're gonna take a very simple test altogether, and don't worry, that won't involve any, hugging or anything with your neighbor. So don't sweat it. It's gonna be very, very simple and painless. Right, so take a look at this picture, drawing, and more specifically about the box A and box B, right? Everybody sees that? And the question is box A darker than box B? So who thinks box A is darker than box B? Come on, guys, you're human beings. So who thinks box A is lighter than box B? Which is also possible. So who thinks they are the same? Any cyborgs? Yes, we have some cyborgs in the room today. And you would be right. They're both identical. Right? So what's the takeaway of this very simple test? For the average Joe, including myself, we suck at this kind of test because this is how we're wired, right? For a machine, it's a piece of cake. They do that instantly, So once you accept that you suck at making. This is not actually a complex problem here, but when afterwards you switch to finance, where you're bombarded by, lots of, data every day, whether it's the Fed or whether it's Trump here or, unemployment data or this or that, how am I going to be able to invest my money with this huge amount of data, and I'm not even able to crack this kind of very simple problem? So for me, I was sold. I thought, okay, I need to use a machine to help me invest my money. Otherwise, I won't last. Okay, so if you fast forward this simple test to the finance world, you will realize that actually most of the financial professionals suck, okay? This is a report from the S&P, the Standard & Poor, which is one of these agencies whose role is to track all this kind of data. So what we have here is they measured the number of funds. So when I said number of funds, it could be a TD fund, could be a RBC fund, could be a Fidelity, could be all these funky funds that most of us buy when we sit down with our financial advisors. And what they do, they compare these funds with their benchmarks after 1 year, after 3 years, 5 years, and 10 years. And what we see is that 90% of these funds suck. They cannot match what they're supposed to track, right? Of course, you could say, yes, they need to get paid. You have some fees on that, and yes, you would be right. That's one thing. But the other thing is, most of these guys are discretionary investors. They use all these data that they are bombarded with every day, and they make a decision based on that. And to me, it looks like it doesn't work, right? So what do we do? Once you realize that your financial advisor doesn't know more than you, are you going to still keep investing your money with him or her? Well, I took the option of doing it on my own. At least I'm going to save on the fees, right? And I decided to use machine to do that. So I am what we call a quant, right? It sounds very funky, very sexy, very complex. It can be very complex. The high-frequency traders are quant, 100% quant. They trade millions shares every minute. They use machines. That's one type of quant. I am at the opposite side of the spectrum. I trade only once a month, but it's still quant. I don't make any discretionary decision. And so, yes, it can be complex, but it can be very simple. And I'm going to show you how you can be a very simple quant, which doesn't mean it's going to be easy to implement, okay? Because simple things are not necessarily easy. And we know tons of simple stuff. You know, like you go to the restaurant, you love the dinner you just had, you want to talk to your chef, and the chef say, this is the ingredients you need to put together, and there you go. You go back home, you try to do the same, and doesn't taste the same. Looks simple, but it's not easy. Well, investment is the same. You have very simple techniques, quant techniques, and actually, I would say the more simple they are, the toughest they are to implement, to execute. All right, so let's take our first example. We're going to take a 10-year-old quant, and he has a very simple model, right? This kid, because he goes to school, doesn't have much time, he's going to do that once a month. And once a month, what does he do? He looks at the price. The price of what? We're going to take the S&P 500. Why the S&P 500? Because this is the benchmark that most of the investors are using. The S&P 500 represent the 500 largest US companies. So the kid, at the end of the month, what he does, he looks at the price of the S&P. If the price is above the 10-month simple moving average, he's long, meaning if it's the beginning of his trade, if he never traded before, it's going to buy. If he bought already, is going to do nothing, right? Simple moving average, it's very simple. We take the 10 last prices of the 10 last months. So you have 10 points, you average that. So you divide by 10. You add them up, divide by 10. Simple, right? If it's below, then you don't buy the S&P, you buy bonds. So you're either 100% S&P 500 or 100% bonds. What type of bonds? I take a basket of bonds. You know, you can buy anything like a Vanguard basket of funds or BlackRock. It's over there. You can try to do the opposite. And because you're quant, you're going to do a back test. And this is what I'm going to show you. Okay? Afterwards, in the end, it's, do I want to make money or do I want to lose money? So we're going to assume that this kid wants to make money. That's a good question. Because there are people, they don't want to make money. They want to lose money. I'm not kidding. Right? So the kid does that once a month. And we're going to see how it looks like when we applied this very simple algo on the S&P 500. So first, I'm going to show you what the SP 500 looks like, the price. So what you have here, the green line is the S&P 500 since end of the 80s, right? So it's simply the price, fluctuation of the price. You see the big crash in the 2000 and 2008. The blue line is the moving average, okay? So I've done that by using a free software online. You know, I mean, it's a web-based software. And the granularity, it's month, okay? But you could do that with days if you want. But again, we have to remember that we want to do that only once a month. So now, essentially, here we have our two parameters, price and moving average. Okay, two parameters, very simple stuff. So now let's see when we backtest this very simple algo, what it looks like. Okay, so the blue line is what we call the equity curve, which is the money that goes into your pocket. Had you invested $100 back in the 80s, I think I go back to March 80, you would have, as of today, sorry, I don't have my glasses, around 5,500, okay? The red line is the buy and hold. So that means March 80, you would have bought the S&P 500 and held it until now, okay? Dividends are reinvested. Okay, so that's what we call total returns. So first conclusion, the kid rules. Not bad, eh? What's that? Yes. I didn't show you the allocation between bonds and S&P, but yes, at some point he was in bonds. What I'm showing you right now is what I call a financial advisor chart. Why? Because it's linear. So you have the compounding effect that is magnified on the right-hand side. It's a kind of, ooh, you want to buy that? And you go, yeah. Well, hang on a sec. Let's apply a log to have a better picture, okay? So log, essentially what we do, we expand at the beginning and we compress at the end. We kind of get rid of the compounding effect. So what we see is that the kid achieves these great returns with a lower volatility. So in other words, the blue line seems to be less volatile than the red one, like the 2000 crash, the internet bubble, 2001, The kid goes through that like he's sailing. And then you have 2008 coming up. He has a little bit dip and then nothing much. So not only he's beating the buy and hold, but he's doing so with a lower volatility. And lower volatility, I translate that by the puke factor, right? The people who bought and held the S&P 500 most likely puked in 2000. Usually it's puke followed by sell, okay? If they held 2002, 3, most likely they puked and sold everything in 2008. Because in 2008 you had a 50% drop, all right? So that means you started at 100, you went up at maybe, let's say 3 grand, and then from 3 grand you go back to 1,500. If you have $1 million portfolio, you become suicidal, right? If you're a financial advisor, you don't care because it's not your money, you know, and you're gonna get the fees anyway. But I guarantee you that what we call the maximum drawdown, the max DD, this is what you need to look at before putting your money to work. Now, some of you could say, hey, this is great, Francois, you took the S&P 500, maybe, you know, you kind of knew it would work. Yes, maybe. So, I'm gonna give you another example. If I ask you, who's the most famous investor in the world? There we go, Mr. Warren Buffett. He's a killer. He's a killer because he averaged around 20% per year for the past 40 years, something like this. This is crazy. This is crazy. Now, when I say 20% per year, I'm talking about a 20% CAGR. Sounds pretty cool. It doesn't mean that every year you're gonna get 20%. Mr. Warren Buffett, in 2008, suffered a drawdown of 45%, right? 45%. But he's Buffett. He doesn't care. He's a multi-billionaire, you know? If you say, yes, I want to follow Buffett, I'm a Buffett guy, I'm going to follow his strategy. Sure. But are you cut to take a 45% drawdown? You know, think about that. Let's say you have $1 million. You start with Buffett. Buffett has 10 billions, okay? And then a month later, you have a 45% drawdown. Well, let me tell you that the first month before the drawdown, you're gonna tell your friends, family, hey, I am with Warren, I rock. You're gonna tell the world, I am with Warren, right? 45% drawdown. So that means you're down from $1 million to $500,000, right? Are you gonna talk to your friends and family? No. No, that's it. You're done. You feel like a loser. Warren, well, he started at 10 billion. He has what, 5 billions? He doesn't care. He can take another 10%, another 20%, no problem. Get my point? So, let's see what the kid did against Warren. So first, this is the history of Warren's company called Berkshire Hathaway, publicly traded. You can buy that. This is the expensive one. There is the cheaper version. I'm using the expensive one because the data goes back to the 80s. But same idea, same algo. You look at the price once a month. If it's above, you buy or you keep. If it's below, you go bond. Now let's look at the backtest. So this is the financial advisor chart, linear. Well, yes, Buffett is good. He's better than Kidd, no doubt. So Warren averaged 20.5% a year. The Kidd is at 19.3, which is still pretty darn good. Let's look at the log. The log is pretty good. I mean, for the Kidd and for Warren, obviously, but for the Kidd too. What's very interesting here is that, yes, Warren beats the Kidd. If you look at the absolute return, 20 0.5%, yes, no problem. But he achieves that with a maximum drawdown of almost 45%. You know, the story with the friends and, you know, neighbors and stuff. Well, the kid does a 19.3%, a little bit less, but at 33% maximum drawdown. So the kid still talks to his friend about his algo. You don't anymore at 45% drawdown, right? So that's when you do the ratio of the CAGR to the max drawdown, that's what we call the MAR, right? That's an important parameter to look at for any backtest or for any funds if you have the chance to find this piece of information, because they usually don't show this kind of stuff. So, yes, before I go to the next slide, which is going to be more quantopian kind of stuff, where we're going to talk about Python. Do you have any questions about these charts? Yep. So that's the maximum drawdown. That means in the history of in the equity curve, you know, at some point you would have faced a 33% drawdown. That means you would have gone from 100 to 77. 66. Yeah, I don't do math in public, sorry. No problem. I will post these slides on the Meetup feed. Yes? Sorry, say that again? How sensitive are the results to the start point? It is sensitive. I didn't put the returns per year. I guess your question is how much data snooping have done on these things. I would say none. What I've been trying to find is are companies that have been around for since the 80s. Data is, you know, is power. That's information. So right now on Yahoo Finance, this is where you can get all this data, and I go back to the 80s. The point of this little exercise is you can take anything you want, any company, any commodity. You can take gold, oil, pork belly, bonds, currencies, anything that has been traded for at least 20 years, and you apply this algo, and you will see the same result, which is you increase your return risk adjusted. Okay? And yes, sorry. Okay, maybe in the back and then you after. How did you come up with the 10 months? Great. Okay, so the question is why 10 months, which is a great question. There have been lots of white papers, lots of studies on these things. We know that anything between 3, 10, 12, 14 works. Why? Herd effect. There are lots of social studies that are trying to explain these anomalies, because this is one of the anomalies of the efficient market hypothesis. So you can pick anything from 3 to 14 backtest, and you'll see the same increase in the return risk adjusted. So here I took 10 because lots of practitioners use 10. Could have taken 9, 11. I've done tons of back testing with different look back, and you get the same stuff. In the end, it doesn't really matter whether you're going to take 10 or 10.5 or 9.75. You take whatever you want, but you're going to have to stick with it. And let me tell you, this is where the simple is different than easy. Execution is 90% of this thing. Yes. Sure. How are we doing for the time? Sorry, this one? Okay. So your question is about the red line when it goes underneath the blue line? Red, sorry, yes. That's the kid, yes. Yes. Yes, that's correct. That's correct. You never know. You never know. And that's something you need also to accept. Not only with this, not only with discretionary trading, it becomes a philosophical subject here, but with everything in life, you never know what's going to happen tomorrow. So you can have the best back test in the world, but you don't know if it's going to work tomorrow, in 1 month, in 10 months. I have no idea. It's March 80, I believe. Yes, 1980, yeah. So we have about 37 years of data. Yes, yes, sorry, back to you. Yes. Yeah, volatility has increased. I mean, we could talk the whole night about the whys. Now, does that affect my way of putting my money to work? No. Sorry, it's pretty dry answer. Sorry, I have another question. You have to raise your hand, man. Yes. Yes. You could go to cash. Okay. If you think, well, these days, man, the bonds, they can always go up. I mean, the price can always go up. So, you know, all these crazy bubble stories about bonds and QE and blah, blah, blah. Sure, you can put your money to cash. Now, afterwards, the question is, with this kind of strategy, you can be long the S&P, or you can be cash for maybe 2-3 years. So you need to look afterwards at the inflation, the opportunity cost of staying cash as opposed to at least, you know, treasury bills or stuff like this. You know, you don't want to lose to the inflation. Yep. Yes, so question, shorting instead of going bonds or cash. Yes, you can try. Shorting in general is very, how can I say that? Risky. Everything is risky, but shorting is really, could be nasty, okay? Because when the market goes south, this is usually where you see the highest volatility in bear markets. Okay, so we know that. So when you short, that means you're going to be slapped in the face at some point. I've been doing some back tests with shorting. I never found anything shorting. It's not my thing. I'm not saying it's not possible. If you read, there is a great book called the first book by Andreas Kleno, a great guy out of Zurich. I translated his second book in French. I mean, if we have any francophone here. But the guy shows that the contribution of the short side for hedge funds, quant hedge funds, it's only 20%. So most of your returns, 80% of your returns are coming from the long side. Following the trend. Yes, sir. Yes.
So in that 10-year period, you've seen it reverse that every time it's still low, you
Yes.
shouldn't be buying, you should be doing the opposite.
Yes.
So your algo didn't have to be static the entire 30 years. You could have switched it.
So let me try to understand. Are you talking about the frequency of looking at the algo instead of 1 month looking it?
No, so you still do it once a month.
Okay.
But for that 10-year period that you pointed out that you're actually underperforming the S&P,
Mm-hmm.
in that 10-year period, you could decide, oh, my algo needs to be maybe reversed.
You can try. You can try. There is a risk of. So I guess your question is, okay, when are you gonna pull the trigger on changing your strategy? When do you know that your algo doesn't work anymore? And that's the question number one of all quant guys. It's when do you know that your stuff doesn't work? To answer that, I mean, the first answer is diversify your quant algos. Don't use only one. You can use multiple with multiple look backs. So the key here is using a 10-month. You could use a five, from 5 to 10, and scale in, scale up. So diversify your strategies, but you never know when it's broken. You always know after the facts when you hurt. When everything's working, you don't think, oh man, how come it's working? It's kind of weird, I'm going to change that. No, you let it run. It's only when it goes down that you think, okay, maybe I should do something. Well, maybe there's nothing to do. It's part of the algo. It's like you're getting married with your algo, and it's back to simple is not easy. That's exactly it. It's very tough. Question? How often do I? So it's very simple. So at the end of the month, during the day, you look at the price. If you have a switch, you sell and you buy the other one. You try to do that is in a minimum amount of time, and you're done. That's right. That's right. This algo is 100% one position. That's right. It's either or. Yes. I, I use yoga. No, I don't use this kind of stuff. I'm not sure I actually understood the cron. I think it's very nerdy. Yes, you could do that. Yeah, absolutely. You can fully automatize this kind of stuff. I still trade manually, but based on what my algo is telling me. Yes. I tried to trade on 1 minute bar in the very beginning. I did all these stupid things, and luckily, I didn't go bust. And so from 1 minute, I am at 1 month bar now. And if I could have an algo that tells me to trade only once every quarter, maybe I'll take it, but I don't have enough data for that. And the difficult thing to do is nothing. That's why yoga is good. Yes. Yeah, so the question is whether, instead of rebalancing once a month, you do that more frequently. Yes, you can backtest that on a daily basis if you want. I mean, I've done it daily, weekly, bi-weekly. You don't get much. And yes, you're going to give money, extra money to your broker, and they love that. But you're going to create more, emotion, more drama. As long as you backtest, if your monthly backtest looks as good as a daily backtest, go. Join while you can. No transaction cost. But these days, you're gonna pay what? Even if you trade every month, which with this kind of stuff, you would trade at some point. You would trade maybe once every 3 years. When you have a bull market, a bear market, you're not gonna do much. It's extremely boring. So you're gonna spend maybe $20 every 3 years. So that's pretty reasonable, and it's totally scalable. Yes. This is the ETF. The the actual stocks. Yeah. Of course you can do that with futures if you know. The SPX is the index, but doesn't include the dividends. This is the actual the ETF that you buy and sell. Yes. I never tried with futures. I've started with ETF, and I was able to grab data for the ETF, so that's where I'm stuck with. But yeah, the CTAs, I mean the commodity traders, they most of them are quant guys. They trade the futures. Retail traders like myself, some of them use futures, maybe like you do. I use ETF, but pretty much the same. We good? Yes? Sorry, say that again. Sorry, I didn't get that. I'm trading. Right. Well, the data, you mean whether it's live data or not? Yes, it is live data. Yes. I'm not sure I understand when you say synchronized, but there is barely no time difference. When you trade at the end of the month, if you decide to trade at the end of the month, you trade when the markets are open. You have a live feed free, whether you use Google, Yahoo Finance, or your broker. It's live. If you're my client, okay, so I don't have really clients. The only clients that I have are people who are, so this is back to the SPY Surfer, what the SPY Surfer does. So I run 6 ETF models, purely quant, and most of my friends, and also unknown people, but they are mostly my friends, they made a donation to BC Children or Sick Kids, and they are on the program for 1 year, which means every month they receive my trades. Okay, so I tell them what to buy, what to sell, but I have zero, I don't know whether or not they're going to act upon it, so it's up to them to take the trades. But other than that, the only money that I trade is mine and family. What was that your question? Now, if you have $100 million, we can talk later, How am I doing, Boris, for the time? I'm just going to show you guys about Quantopian. I have only 2 slides about Quantopian because I guess most of you guys are Python crazy coders. So Quantopian is the platform where you can backtest all your ideas. If you have a model and say, hey, I would like to backtest these things. So you go on their platform, it's free. You punch your code that's on the left-hand side, and then it's going to backtest your strategy right away. It's going to crunch all these metrics for you. And what Quantopian does, and I don't work for them, just to be clear here, but I really respect the work that they do, because I think this industry, the investment industry is totally ripe for disruption, as we saw from the third charts, where it's their business model is you win, they win, you lose, they win. So that has to change, So Quantopian is kind of shaking the tree, and they essentially identify traders in the world. You can be, located in Tahiti if you want, but you use their platform. And if they like your strategy, they're gonna incubate the strategy for 6 months. And then afterwards, they'll give you a call, say, hey, we'd like to put, 10 million on your strategy. And they'll give you, I think, 10% on the profit. And recently, they had $250 million with a B coming from Steve Cohen. He said, okay, here is my 250 mil, allocate. So have a look. And also, I know that they have a contest where you can make some money. So you would, as far as I understand, you would sign an agreement with them. So they are very thorough on the contract you would sign with them. I don't know more about how it works and stuff. But if you are a Python coder, have a look. And that's about it for me. Thank you.
Thank you very much, Francois. Yeah, in fact, Quantopian. Anybody here know Jupyter Notebook, Jupyter platform? So yeah, Quantopian, they actually provide a Jupyter platform that allows you to log in and access all those financial data that have, as well as the frequent presenter. Anybody here use PyMC? Yeah, it's a Bayesian learning framework that like Ben also uses it. So yeah, Thomas from Quantopian also did a presentation last year on the framework. It's really cool. Recommend you check out the video. Our next presenter is Ben. Ben is awesome. Check out his blog, benfredrickson.com, and yeah, it's a lot of really cool article there that he wrote. So yeah, without further ado, I'll pass it to Ben.
So, like Boris was saying, my name is Ben Fredrickson. I guess I should stand over here by the mic. Can I take this off? Is it wireless? Awesome. So my name's Ben Fredrickson. I'm a software developer here in Vancouver. I work for a company called Flipboard. We're a news app. We pre-installed on a lot of Samsung phones, so you might know of us. What we do at Flipboard is we try to find news that people will like. So our job is to identify articles that people might like and actually present them to people in a format and context that I think looks pretty good. So I work for Flipboard up here with a couple other people. I see a couple faces in the crowd that I work with. And the team up here, at least my team up here, works on doing things like topics and recommendations. So we're doing a lot of work with data. We do a lot of work in Python. And that's actually what I'm going to talk to you all today about. So my talk today is going to be on learning from implicit data. And I'm going to give examples using NumPy, SciPy, and Pandas. I'm really actually going to be summarizing a bunch of blog posts I've written over the years. So my blog's at benfredrickson.com/blog. I don't know if anyone here's read it. Anyone? Oh, awesome. So excellent. So some people here are familiar. There's not actually, unfortunately, going to be that much new here in my talk for you, but hopefully everyone else finds this at least somewhat interesting. So what I'm going to be talking about today is what is implicit data, exactly what I mean by implicit data, why I think this is an important problem, and why it's interesting. I'm going to cover a couple common algorithms for making predictions, especially recommendations on implicit data. And in fact, we're going to be moving from stock predictions to music. So we're going to be trying to recommend musicians to people rather than recommend stocks. So hopefully it'll be somewhat interesting at least. And the cool thing about this talk is I'm going to be not showing you any math. I'm just going to be showing, well, actually, that's not true. I'm not going to be showing you much math. It's going to be actually using simple Python code, using the PyData stack. So it'll be SciPy, NumPy, Pandas, to build a simple music recommender. Yeah, so let's just get started here. So at Flipboard, we actually let people rate news articles. So you can say, hey, I like this article, or I don't like this article. And I thought it would be interesting to show the relative ratio of likes versus dislikes. So this is the data from last week on Flipboard. And you can see we have about 15 times as many likes as dislikes. So out of all of the combined actions, we have 93% of our data is positive. And you can make the case with Flipboard, like we might be a little biased. I don't know if anyone's here used the app. It's actually hard to dislike something. It's in the submenu, so it could be a little bit off. But we're not actually that different than other popular sites online. So a couple years ago, I pulled up some open data sets and sort of broke down the ratings from the Yelp academic data set, the Amazon rating data set, Netflix Prize, and Reddit. And everything, all of these data sets, even though they're different industries, different rating systems, they're all about 85% sort of positive, or about 15% negative, however you want to view it. So we're not too far out. But the problem's actually, it's not just one of class imbalance, which you might be thinking like, hey, you still have explicit data, you have some positive, some negative. If you actually look at the number of article views on Flipboard, the problem's a lot worse. So we have 15 times as many likes as dislikes, but we have 100 times as many article views as likes. So we end up having all of this positive data and very little corresponding negative data. And the interesting thing too is that we actually, 99% of our user base hasn't disliked anything. And we still have to make decisions on what to show them, even though we don't have any negative data. And this really means that we can't do a lot of sort of classic collaborative filtering on explicit data. We have to focus on the implicit data. So if you view an article, we don't necessarily know that you like it, but we can sort of infer that you like it. If you viewed it and you spent 30 or 40 seconds reading it, or minutes even in some cases, we can be like, okay, yeah, we think you've liked this article because you've interacted with it for some time. So implicit data, it actually has a couple problems. It's noisier than explicit data. It's positive only. We don't have any negative data. We don't have the data, there's no such thing as unviewing an article. Trust me. And there's, but the plus side is it's a lot more plentiful, and you can still do some pretty cool things with it. And actually, that's what I'm going to be talking about in this talk is, like I said, we're going to be talking about doing music. And so the first step is I'm going to load up a data set from Last.fm. And Last.fm is a music service. People scrabble whatever they've listened to. I don't know if it's still super active anymore, but there's a data set online. It was put together by Oscar Selma. He's actually head of research at Pandora now, but he did this as part of his PhD. And it has triples of user hashes, artist names, and play counts. And so there's about 300,000 artists, 360,000 users, and 17 million total rows. So it's a decent data set. So to load it up, I'm going to use pandas. And pandas, I don't know, how many people here have used pandas before? Yeah, okay, almost everyone. That's awesome. So pandas is great. It's a one-line command to load up a tab-separated file like we're dealing with here into a data frame. All of this rest of my code, though, I'm going to be working on sparse matrices instead of data frames. So we still need to map it. What I'm going to do is use the data as type category, and that actually will map the string column in the data frame down to a categorical comment, which basically assigns a unique numeric integer, auto-incrementing. So we can use these as row ID and call IDs in our sparse matrix. And then I'm just going to create it a SciPy sparse matrix out of it. And so it's a COO matrix. It's like triples of row ID, call ID, and values. So cool. So I'm going to be talking about a couple of algorithms in this talk. So there's three different ways, main different ways of dealing with implicit data, at least for making recommendations. There's nearest neighbor models, there's matrix factorization models, and there's a bunch of other models that rely on sampling the negative data. So the negative data in this case will be all the articles or all the bands the user didn't listen to. We don't actually want to do work on all of the negative data. Like I said, we have 17 million positive examples, but there's actually, it's a 300,000 by 360,000 dimensional matrix, so there's 100 billion negative things. So if we actually had to do work on every single negative item, it'd be like 6,000 times as much processing for like very negligible gain. So the first two algorithms that I'm actually going to talk about can work just on the positive data and still make inference. And the third one I'm just going to skip over and just mention that sort of the idea behind models like word-to-vec and factorization machines and Bayesian personalized ranking and stuff like that. So the first thing I'm going to talk about is nearest neighbors models. And when doing this, it's really quite simple. Like what we're going to be doing here is I'm going to be doing something called item-item collaborative filtering. So what we're going to do is we're going to measure the distance from each artist to each other artist and use that to build a recommender. And because it's actually pretty hard to show personalized results, I'm not going to show personalized results. So what I'm really going to do is just show things in a fashion of a feature, say, like, if you like this, you may also like all these other things. So just show results for a single item rather than for users. So, because it's really hard to demo personalized products. So with the nearest neighbors models, the trick here is actually computing the distance between each artist. And what we're going to do is I'm actually going to represent each artist as a sparse vector of all the users that have listened to them. So we'll have the artist, it will be a 360,000 dimensional vector of user ID to play counts. And the easiest way I know of doing this is treating this as a geometry problem. So as a for instance, take a look at this graph. There's two hypothetical users here. There's user A and user B. And user A has listened to a lot of Kanye West, and user B hasn't. And what we're really going to do here is actually try to measure the angle between one and the other. So what we're going to do is measure the angle from Kanye West to JZ, or Jay-Z as he's sometimes known in America, and compare that to the angle from Kanye West to ZZ Top, or ZZ Top, depending on how you really want to go off. And you can see, like from this hypothetical example, the angle between Jay-Z and Kanye West is relatively small. So we can infer that they're quite a bit more similar, given this graph. And the angle is quite a bit more large to ZZ Top. Like I said, we have a 360,000 dimensional vector for each user rather than a two-dimensional vector, but the idea is the same. We're going to measure the angle in this 360,000 dimensional space. And the code to do this in Python is super simple. It's actually 2 lines of code. So the first thing you do, oh man, it is truncated at the top. I don't know if it's possible to adjust that. Cool. So just imagine that the first line is saying def cosine on plays. So we're having a cosine similarity on plays. So we have a function that takes that input matrix that we just loaded up from pandas and is trying to return a similarity matrix. So what it's going to do is it's going to normalize the matrix. So we're treating each artist as a vector of their users. We actually want each artist to have a unit length. So we're going to normalize it by dividing by the L2 norm, or Euclidean distance of, of it all. I'll talk a little bit more about that in the next slide. And then all we have to do to compute the cosine is actually to state the dot product to this matrix to itself. So it's super simple. The cosine between two sparse vectors is just the dot product divided by the L2 norm, or and you know, to return the top items, all we have to do is take the top ranked things from each row in this similarity matrix. And so, again, this is cut off here. Yeah. But imagine that this is my implementation of normalize. Actually, sklearn has a normalize function that I probably recommend using anyways. It's an sklearn preprocessing. But it's not hard to actually write this yourself. So this function will actually normalize that matrix, dividing each row so that the row has a unit length. So the first line, row norms, actually calculates the square root of the sum of the squares for each value. Uses NumPy's bin count. So the bin count of x.row sums it up over the row IDs. The x.data sums up the square of the datas. And then we just divide it, divide the matrix. And actually, I like, this might be all very second nature to everyone here, but actually, I think one of the cool features of NumPy that I always like talking about is its array indexing feature. So when I go x.data / row norms of x.row, what we're actually doing is x.row, that's the vector, that's a NumPy array of all of the row IDs in the sparse matrix. And we're passing that to our row norms, which maps between row ID and the norm for the row. So what this does is it actually, by passing one array as an index to another, it looks it up and creates, does the transformation that we want. So, cool. Unfortunately, that's good enough. Unfortunately, the results here aren't all that awesome. So the top result, when you look at by cosine distance to Radiohead, is Tom York, and he's the lead singer. So that's good, that's awesome. But then the second result is this artist Samara there. And I had to look her up. Apparently she's a DJ in Australia. There's exactly 2 users out of the 360,000 users in the data set here that have listened to Samara. So I feel good about not having known it. But one of the users has listened to Radiohead 100,000 times. So one of those 2 users has listened to Radiohead 100,000 times. And that's enough to totally skew the results. So the challenge here is to come up with a model that works a little better. And I'm just gonna quickly talk about one of them. And the idea here is talking about BM25. So the idea is, instead of just doing a simple cosine, we're actually gonna treat this as an information retrieval problem. So this is a model, BM25 is a model that search engines sometimes use for returning results on text documents. So in effect, we're treating each artist as a document and each user of the artist as a term inside the document, then doing a text similarity comparison on them. And one of the key things it does is actually damps the count by this function. So this function here is the term weighting that we're gonna use. Instead of a linear weighting like we're using cosine, we're gonna apply this BM25 term weighting, which looks sort of something like this. As the play count goes up, that BM25 weighting with a K1 value of 100 actually approaches this asymptote of about 101. So that user that's listened to Radiohead 100,000 times will only ever get about 101 times as much weight as the user that listened to them only once and decided that they didn't like it. And there's a couple other differences with BM25 from pure cosine, and I'm gonna talk about them quickly here. So this function returns a BM25 weighting of the matrix. So if you could see the top line, which you can't, it would say BM25 weight on a matrix. There's 2 differences between this and just a pure cosine. One of which is gonna be what I call IDF, or what is called IDF weighting, which means inverse document frequency. So the intuition is, a lot of times, users that are selective in what they listen to are a better indicator than users that aren't. We don't want to give as much weight to a user that listens to every single artist as one that's only listened to a handful, because the users that have only listened to a handful are probably a better indicator that they're really into it. So the way it does this is in that line, IDF equals log, et cetera. It's all it is the inverse frequencies. So n is the number of documents, 1 over bin count is the number of times the users listen to, like the number of artists the users listen to. And IDF is really just the inverse of that in log space. And it gets multiplied in the final step. And the other big block of code is on how length normalization is happening. With cosine, we just did a straight up normalization. BM25 is a little slicker. It actually compares each play count to the average play count. Or sorry, it compares each artist's, the number of plays for each artist, to the average plays for all artists, and scales the play count accordingly. But because sometimes it doesn't want to normalize, you don't want to normalize fully, it actually adds another parameter b, which lets you, it lets you bias towards, in text search, sometimes it makes sense to want longer documents. Like if the term appears in a document like 5 times, it might be better than a document that's a 1/5 the length and the term only appears in once. And in our case, what it really means is it lets us bias things back towards popular artists. And then we're just gonna put the whole thing together, scaling the counts, applying the IDF, applying that BM25 term weight function in that last line, and then just take the dot product again. And the results here, I hope everyone can see this. The results here are quite a bit better. That Samara artist is totally, the counts are totally gotten rid of. The number 2 artist there, I hadn't heard of him either. Apparently he's also in Radiohead, so it's actually a pretty good result. He's like a guitarist or bass player or something. And the other artists are, the other top related artists to Radiohead by BM25 on this data set are Interpol, Sigur Rós, Smashing Pumpkins, and things that I guess are hopefully somewhat related. Which is good. And the cool result here is that this isn't actually a very big data set. I can run this entire computation on all artists on my laptop in about a minute. It's, including loading it up, including calculating all the similarity. And you can still get decent results. If you look at the results actually on Last.fm, they're not gonna be tremendously different from what we're seeing here. But there's still better models that we can talk about. And one of the ones I want to talk about is using matrix factorization. And I hope this isn't going to be too much depth, but the idea with matrix factorization, it's actually been shown in a lot of cases to produce quite a bit better recommendations than doing shared nearest neighbors models. And the idea is that we're going to transform the artist user play count matrix, the gigantic sparse matrix, down to two skinnier dense matrices, so that resemble or approximate the original matrix when you multiply them together. So instead of representing each artist as a 360,000 dimensional vector in the original large matrix, we'll represent them as by a 50-dimensional dense vector in the factorized matrix. And the intuition behind this is that by factorizing the matrix, you're compressing it. You're compressing one big matrix down to two smaller ones. And the compression forces generalization. And the generalization is sort of key to understanding. And I'm going to hopefully actually give you a result, how this actually generalizes later on. But that's sort of the idea. Oh boy. The simplest way of doing this is going to be using a singular value decomposition, or SVD. The first line actually imports this that you can't see from SciPy sparse lineage. It imports SVD. Yeah, actually, I could probably do that. Yeah. Display settings. This one. Built in?
Try that. Fantastic.
That is worse.
Yeah. Scaled? Yeah, go ahead.
Yeah, that's maybe better. Yeah, let's give it a go. I'll just finish talking about it. It's totally cut off, but it actually won't make that much of a difference. Like, we're actually almost done, so I realize we're running a little late here. So, using the SVD, it's the same sort of technique you use when doing things like principal component analysis, multi-dimensional scaling, a bunch of other things. And what I'm going to do is actually I'm going to use that same BM25 weighting that we use for nearest neighbors approach and weight the matrix by that and compute the SVD on the scaled matrix. And doing this kind of approach is really, in text information retrieval, it's usually referred to something along the lines of latent semantic analysis or latent semantic indexing. And the results are, anyways. So, and to actually return results, what we're going to do is actually just take the cosine in the factorized space. So this code's very similar to the cosine function I showed you earlier. The only real difference is that now it's a dense matrix rather than a sparse matrix, so everything changes a little bit. But it's the same idea. So the thing about doing the raw SVD is it doesn't actually work all that well. SVD has been known to overfit when doing tasks like this for a long time. There's a bunch of reasons for that, but you can look at the results here. So I have no idea who Ludin Wainwright III is. I don't know who the Umbrellas of Cherbourg are, or Moy Cansato, or Wedding Parties anything down at the bottom. So the results actually aren't all that good. I could bring up results that look a little better than this and show some interesting properties, but that's actually not my point. My point is, and this is sort of what I've been building up to most of this talk, is actually I want to talk quickly about this paper. And the paper, it's just slightly truncated at the top. The paper's called Collaborative Filtering for Implicit Feedback Datasets. And it's not particularly new, but it's actually a pretty important paper in doing implicit feedback collaborative filtering. If you ever use Spark MLlib, this is the algorithm that gets used for doing implicit recommendations. Facebook last year, they released a blog post calling recommending items to more than 1 billion people. And this is the algorithm. They don't actually call it out by name, but they describe it perfectly. This is the algorithm that they're using. So it's really quite an ubiquitous matrix factorization algorithm for doing recommendations. And at its core, it's actually pretty simple. I know I promised you not too much math, and I realize that even it's getting late. But what we're doing here is it's actually learning the factors. So XU is the user factors. that we're trying to learn. That's for a particular user. YI is the item factors for a particular artist. And what we're learning here is confidence-weighted least squares regression. So CUI is the confidence we have that the user likes the item. So for all items that the user hasn't viewed, that's going to be 1. And for everything else, we're actually just going to set the same BM25 weighting that we've seen before. And then PUI, that's going to be a binary preference vector. So it'll be 1 for everything that the user's liked and 0 otherwise. So as it turns out, it's pretty easy to actually calculate this directly. So if you fix the item factors Y, you can actually just calculate XU directly. And what that equals is YTCUI plus lambda I, so that's an L2 regularizer. It reduces overfitting that we saw in the SVD. And then YTCUPU. It's actually pretty easy to calculate. And especially because, and this is the cool thing about the paper, is that the paper is, talks about is that it knows that YTCUI is actually, that's fully dense. We'd have to, if we wanted to calculate this directly, we'd have to consider all the negative items, which we don't want to do. But what it knows is YTY, that equals YTY plus YTCU minus 1Y. And CU minus 1 is sparse because the negative items are set to 1. So for the negative items, this thing's sparse, we don't have to worry about it. And YTY can be pre-computed for all users. So the code to do this, to calculate XU, given a confidence matrix, so it says def least squares. All my slides are available online, just in case anyone wants to follow up. And I actually have posted the code too. So, so it says least squares, CUI, XY regularization. That's really what we're going to do. It's just pre-compute YTY for all users. And then for each user, we're just going to accumulate the YTCUI regularization in this variable A, accumulate YTCUPU and B, iterate over the non-zeros of the matrix and update these two things as appropriate, and then solve for XU. So there's a little bit more. We actually, and once we've calculated the user factors, we're just going to calculate the item factors from the user factors and keep on alternating back and forth until it converges. So it's an alternating least squares. So hopefully that makes some sense. You start off at a random state, and you go back and forth. And the results here are quite a bit better. And this is the first results that I want to show. And this is actually showing the results of the generalization process. So the whole point of doing this is because this model generalizes well. And this is what generalization looks like. In this data set, it's gotten from Last.fm users' histories. And that's actually scraped from people's music libraries. And in people's music libraries, they either have Arcade Fire or the Arcade Fire as a label on the band. They don't have both. It actually means the same band. Any of the nearest neighbor methods think that they're entirely different. There are no users in common, so they can't actually, it'll put it right at the end. But this algorithm has actually placed Arcade Fire and the Arcade Fire as being extremely similar based off other users and other similar item sets. And then the results are still good. You have clap your hands, say yeah, national shins, and all other things are hopefully a little bit more related. And likewise, if you look at comparing LSA, which it's the results on the left are from the SVD, to the results on the right are just implicit ALS, that Ludin Wainwright III is pushed way down, and Bob Dylan in the band, comparing for Bob Dylan, is pushed way up. And the band is, I guess is an accompanying band for Bob Dylan, is pushed up. So, yeah, so it works well. It's relatively simple to implement. And the cool thing is it can all run on my laptop. Yeah, and that's really my talk for today. I blew through it a little faster than I meant to, but it's all good. I just wanted to mention a couple things really quick, though. So all of the code for this post is on my GitHub, so github.com/benfred/implicit. The versions, if you're interested in this, are quite a bit more efficient than the code I presented. There's multi-threaded Python versions of everything, as well as the optimization procedure for the implicit ALS model is based off a slightly more efficient paper. And I've actually written 3 or 4 blog posts about what I've just talked about on my blog at benfrederickson.com/blog. Yeah, and that's about it for today. Oh, and one final thing. If any of this is interesting to any of you people here, there's an academic ACM conference on recommender systems. It's actually, the 2017 one is going to be held in Italy in August, which is great. But the 2018 conference is actually going to be held in Vancouver. And I'm actually co-chairing the industry panel at this conference. And I'm interested in talking to anyone that works on recommender systems in Vancouver. We're interested in talking to people that work in local industry on RecSys. So if that applies to any of you, just come see me after here, and I'll be excited to talk to you. So yeah, is there any questions? Hi.
Yeah, not exactly a question. I was a little disappointed to see what your improved algorithm did to Loudon Lehman III, because he was called like the new Bob Dylan when he emerged in
Oh, really?
1970. I guess his most recent thing he did was that he did the tuning nocturne called Gray Relic, but that was like
Oh. So apparently my Bob Dylan example could have been much, much better. And,
I think were better, but I was disappointed because I've always
yeah. It did also get rid of wedding parties anything, which I'm assuming is not related. So, hi. Oh, yeah, actually. Yeah, and we do that. So the question was, have I thought about how to do this in an online setting? So actually do this incrementally. So as data, like, because in the normal case, what will happen is users will continue to listen to items after your model's been published. You don't necessarily want to recompute everything from scratch. Yeah, and implicit data is all clicks and is all views. Well, there's a couple ways of doing this. So the research actually shows that unless your data's changed by more than 30%, you don't actually need to recompute everything. So like I was saying, the user factors can be completely learned from fixed item factors. So as your user, what we do at Flipboard is as your user changes, we just recompute the factors for that user and not actually recompute everything. And then as the items change, because items also change over time. A news article gets published, more people listen to it, more people like it, dislike it, whatever. And we update that. And we only actually do a full retrain periodically. Hi.
Is there evidence that these recommender engines create feedback loops?
They totally create feedback loops, actually. And it's, especially doing articles, it's kind of tricky because you end up with like sort of, a feedback loop on popular items getting more popular. Or people show it, and especially if you're doing stuff on implicit data. So we actually have a problem with clickbait. So if we're going to be training a model on article views, and an article has a really good title, people click on it, we think they like it, we'll show them more of it, and that article gets shown to other people that are similar. I had to halt an A/B test I was running because the CEO of our company got recommended an article talking about aliens building pyramids on Mars. And he follows space, but he wants to see articles about NASA and science. The problem was that this article actually had crazy high engagement. Like basically everyone, it had a 25% click-through rate when our normal rate is closer to 7 or 8. And so it housing tens of thousands of likes and views. So
So are recommender engines a danger to democracy?
in terms of filter bubbles and fake news, and that's actually an interesting question. One of my colleagues is actually going to be publishing a blog post on the Flipboard engineering blog in a couple weeks talking about this, and I don't want to spoil the surprise. It's going to be a great post. So, yeah. Hi.
When you say this runs under a minute on your laptop, is that the threaded Python version?
So the nearest neighbors code. The nearest neighbors code actually, it takes about 25 seconds to load the data frame. And then just what I'm doing is actually doing a sparse matrix multiply to compute everything, and that actually gets translated down to SciPy into C++ code. That actually takes about 20 seconds. The multi-threaded Python version runs faster than that. It's about 9 seconds. To do the matrix factorization code, it's more than a minute on my laptop.
ALS is a little bit slow. Like how long does it take you roughly?
I can generate the results I've shown you with the library with the performance improvements in about 90 seconds on my laptop. The code I've shown you though will be over an hour. It might even be in 2 hours. So it's definitely possible, but it's not. That code isn't especially fast. Hi. Well, it's not terribly sensitive. It's a quadratic loss function, so it's yeah. We have it's sort of a quadratic loss. Yeah, it's pretty stable without yeah. Cool. Well, thanks everyone. I appreciate you all taking the time to listen to me.
Thanks so much, man. That was awesome. Okay, so just two quick call to action. First of all, you might have noticed that we, at the start of the presentation, we have an event called the Global AI Hackathon. It's actually happening this June in Mobify. So if you are interested, would invite you to go and sign up. It's free sign up, so definitely go and check it out, especially right now, we're looking for sponsors. So we can't use implicit data to prove to our sponsor that people are coming. So please explicitly sign up for the meetup. The second call to action is that we are actually, instead of going to Butcher and Bullock, we are actually going to Blackbird for beer. So it's just on Dunsmith Street, 1 block down, and then on the west side, 1 block. So yeah, to come and join us. We're trying to move out soon for get some drinks and food. So everybody is welcome to join, and we can chat to our speaker a bit more. Thank you very much. No, thank you. Oh, and one thing actually, also, people on this side of the room, do you mind actually helping out in moving the chair back? Thank you.